Good morning, everybody. Welcome to the Crowdercast session from Venture Carolina and the South Carolina Angel Network on introductions to deal terms. My name is Paul Clark. I'm one of the managing directors of the South Carolina Angel Network. And I have the pleasure of spending a few minutes with you this morning to run briefly through a few slides to explain some of the basics about early stage company term sheets and deal terms. And then I'm going to answer all the questions that you guys have submitted and will hopefully continue to submit during the course of this session to the Crowder platform. And I look forward to taking your questions and answering them as we go along. So as I said, my name is Paul Clark. I'm one of the 3 managing directors of the South Carolina Angel Network. We have a 501c3 nonprofit called Venture Carolina that we do our educational activity through. And this seminar or this Q&A session is one of the activities that nonprofit does. If you'd like to follow along with the slides that we'll talk about briefly, they're on the SCAN website, scangelnetwork.com, under Investor Resources. It's a very brief and painless set of slides for us to go through briefly, but we'll spend most of the time answering questions and doing it in a Q&A format. But just to kick things off, just a quick disclaimer at the beginning, I'm not an attorney or a tax advisor. We're going to talk about some legal and technical and accounting and tax issues potentially as we go along, but none of this is advice. So if you need real advice on creating investment documents or other things, please do get the professional assistance that you need to do those things. As I mentioned, this is a Venture Carolina workshop with the South Carolina Angel Network. And we're doing this on the Crowder.tv platform, which is a recent portfolio company of the South Carolina Angel Network, and a very enjoyable platform to broadcast through and to answer people's questions through. So if you have ways that you could use this in your business, then I strongly encourage you to experiment with it and try. Our agenda for today is a couple of minutes from me just talking about the basics of angel investing and the deal terms associated with those deals. And then, as I say, we'll hand over to the question part of the discussion shortly. There's a few different topic areas to cover when we're talking about term sheets, just to set some kind of parameters around the discussion. So we're talking here about companies that are at the beginning of their life cycle. They're more than just an idea on a piece of paper. They're a real business that's really trying to get going. Typically, we're in a position where the company has a product or a service that they've developed and are ready to take it to a market. Ideally, they've proven that somebody out there will buy it or listen to what they have to say. So we're talking about that kind of company, past the family and friends round typically, but before the company is big enough to attract the attention of venture capitalists. And the terms of those deals typically look something along the lines of an equity round, so raising money by selling shares of your company of somewhere between 100,000, say, and $1 million. And we'll talk about the different deal terms related to economics in a minute. And when you do that, when you take a large sum of money from an outside investor who's not an uncle or a family member, you typically have to give up some control or some influence over your company as well to help the investors safeguard their investment. And so the 2 areas of deal terms that we really talk about are economics relating to the price and the other terms around who gets what when the company is sold, and then control. Who has influence over the company, who runs it, who sits on the board of directors, what rights investors have generally. And so those are the 2 broad buckets that we talk about. When you start designing deal terms, obviously you have to cover some basics. So who's raising money, what kind of security you're selling, who you're going to raise money from, all of which are big questions in themselves that we perhaps don't have time to cover today, but we can talk about perhaps in the Q&A. But once you've got past those absolute basics and you've decided what kind of security you're going to raise, then we get into the questions about economics and control. If you're thinking about raising money from an angel group like ours, we typically almost always exclusively invest in a type of security called convertible preferred equity. And so what does that mean? That means equity, so shares of your company. It's preferred, and that means it gets paid out in the event of some kind of liquidation or sale of the company before the common equity, which is the founders or other people in the family and friends round. And it's convertible because it means it converts from preferred equity into common equity, the kind of equity you have, in certain predefined situations. And if you're following along with the slides, we're on slide 6, so you can see what some of those situations are and how that conversion works. But basically, it's shares of the company that have the same rights as every other shareholder, but with some additional rights and responsibilities as well, that we will talk about as we move forward. So we're assuming, for the purposes of this discussion, that you're raising convertible preferred equity from an angel group, or individual angels or individual investors with the same kind of capabilities as angel investors. So obviously the biggest question when it comes to deal terms is, what price am I selling the shares in this company at, right? And there's myriad discussions out there to try to figure out how you can value a startup company. The short answer is you can't. The only way you can figure out what the startup company is worth is what somebody will pay for shares in that company. If you do that, then that's kind of you've already got to the end of the answer rather than starting at the beginning. So how do you figure out what that price should be that you sell shares at? The approaches that come to mind are try to find other companies in your industry that have raised money at a similar kind of stage of development as you, and try and figure out from there what kind of valuation they raise money at, and that may apply to what you're raising money at. That's hard to do. There's not tons of great data about valuations of early stage companies, but there are some things like the Halo report published by the Angel Capital Association and others, and other discussions out there that might give you some benchmarks to think about. The median startup company valuation for this round we're talking about in 2014 across the US was about a $3 million pre-money. It was less in the Southeast. Maybe we'll talk in the Q&A about why that is. But fundamentally, there are fewer people making investments of this type in the Southeast, so it's harder to get valuations that are as high as that. You can try to benchmark against what companies later in the life cycle are valued at, and then back into what your valuation today might be if you have the potential for becoming a company like that in the future. But a lot of the established methodologies you would use to value publicly traded companies, for example, EBITDA multiples or DCFs or whatever it might be, don't work in early stage situations, obviously, because there isn't cash flow for you to forecast or discount, or EBITDA for you to measure multiples against. So it's somewhat guesswork. Talk to other people that have raised money in your area in similar looking companies if you can. Talk to groups like ours. We see a lot of companies raising money or trying to raise money, and so get a good sense of what other people are raising money at and what we're comfortable investing at, and that will help you benchmark what the price of your stock might be. A couple of important terms you need to know when you're doing that. Investors typically talk about pre-money valuation, so the value of the company before we put our money in. And in general, there's a disconnect between that and what people talk about generally about the valuation. So entrepreneurs typically say, well, I'm selling 25% of my company for $500,000. What does that mean in terms of valuation? And if you don't know what pre-money and post-money mean, then there can be some disconnect. We talk about two slightly different concepts. Pre-money is the value of the company before the money goes in, and post-money is almost the same thing. It's almost the same as that plus the amount of money that goes in, although there's some complexity around option pools or convertible debt and other things that make that a little bit more tricky. But in general, if you're raising a round of the kind I've described, say you're raising $500,000 in a company that has a little bit of revenue, just taking the product to market, it wants growth capital to scale, then somewhere in the range of a $2 to $3 million pre-money valuation won't be dissimilar from other companies raising the same kind of capital. We talk a lot about liquidation preference when we discuss our deal terms in angel groups like ours, and that means who gets paid out first in the event that the company is sold, or if the company is wound up, or the assets are sold, or something less positive happens. And we are preferred equity investors. That means we get paid out first before the common shareholders get paid. And that usually isn't all that important. If the company's done very well, then we convert our shares into the same stock as everybody else, and share pro rata in the proceeds. If the company has not done very well, and is sold for only about the same as the valuation at which we invested, then it becomes more significant, and it's downside protection for us. So in deals that we do, we typically have a 1x liquidation preference, which means we get back the value of our investment first before the common shareholders receive anything. And that's a very standard professional investor type approach to investing. And so when you are designing deal terms, hopefully with your attorney or with other people that know what they're doing, that will be a prominent feature that you'll have to deal with. And that's pretty much mandatory for angel investments that we make. Other important economic factors that we should talk about briefly are anti-dilution. So this is a term that's again used generally, but not necessarily technically very accurately. So we understand, as we're early investors, and as you probably understand as entrepreneurs too, that you're going to keep raising capital over time as you grow. So we fully expect other investors to come in after us and therefore dilute us. And in your position as an entrepreneur, if you're raising money now, you're being diluted at this point when that money comes in. And the same thing is true of all of us then when subsequent rounds of investment are made. And that's not a bad thing. We happily take additional investment in the company if it comes in at a higher valuation than that at which we invested. We're all a smaller piece of a much larger pie at that point. And on paper, we've made some money. The shares are now worth, say, double that they were when we invested. So dilution itself is not necessarily a bad thing. And there's no protection for us against that other than some of the supervisory rules we'll talk about in a minute. But in general, dilution is okay. When it's bad is when we're having to raise money at a lower valuation than that at which we invested. And in that situation, typically that only happens when a company hasn't executed on the plan that they presented to the investors, and things haven't gone as well as they were alleged or were predicted to have done. And in that case, the investors in the earlier rounds typically get some form of anti-dilution protection, which means it basically means the value at which they invested is reduced, so they get more shares for their investment, and therefore dilute the original founders a bit more heavily than they would have done ordinarily if everybody was being diluted in the same way. And that's, again, pretty standard. About 95% of deals have what's called weighted average anti-dilution protection, which means we look at how much money is coming in, what valuation is coming in at versus how much money we put in and how much the valuation we put it in at, and we come together in the middle using a predetermined formula about how much additional dilution the entrepreneurs face relative to the investors. And that's pretty standard, and that will be in most of the deals that we look at in our groups. So those are the key important parts for the economic side of the equation. On the control side of the equation, it often comes as a surprise to entrepreneurs that they have to give up or they have to set up a formal board of directors for their company when they take outside capital of a significant amount. And typically what happens in a deal of the kind we do is we set up a 5-person board, 2 from the common shareholders, so the CEO and the CFO or the COO or something, 2 from the incoming shareholders, the preferred round shareholders, and 1 independent board member that we all agree on. And the purpose of this board is really to be the representatives of all the shareholders in the company and help run the company for the benefit of all those shareholders, not necessarily just the CEO or the founder. And so there are obviously well-trodden rules, predetermined rules about what happens in formal board situations. And it should be expected that entrepreneurs face that formal board structure, sometimes for the first time when they take money like this. We almost always insist on that 5-person board structure. Sometimes it might be a 3-person board or 7 or something, but typically that kind of board structure is mandatory for taking equity investment like the kind that we provide. And hopefully you get something beneficial as entrepreneurs from that board. Our angels in our groups are 230 of the most successful and experienced business people in Western North Carolina and South Carolina. So they, as board representatives, can provide a lot of value to your company: connections, strategic advice, assistance with helping your company get to an exit situation. And hopefully are providing a great deal of a value add, not just the capital that we provide, but the assistance that we can provide to help you execute on your business plan. And having experienced executives on the board of directors is a key factor in helping companies get to a successful development. So you should absolutely expect to see that in the deal terms that you offer or you're given by potential investors. And then other rights that we expect as standard: we expect you to keep us informed. So every quarter at least, Ideally, more frequently than that, you're providing us with some kind of report, some managerial discussion, and some financials. At the very least, we're expecting to see your budget and your annual financials, but quarterly is the standard. So we expect to be kept informed. We want to know how things are doing. And the most successful entrepreneurs are those that are even more proactive than that, that actually provide at least monthly information, that interact more informally with the investors more frequently, to solicit advice, to get contacts, to keep everybody informed about what's going on, so that when things do go wrong, which they do quite a lot of the time, nobody's surprised by that. People have time to prepare, and people have more goodwill that can be burnt through before things have gone terribly badly than if you surprise them with bad news. So information rights are important. Redemption rights is the other area of discussion that we often get in when we're talking to entrepreneurs about term sheets. And redemption rights is a right for the investors like us to get our money back in certain situations. We're typically looking for companies that have the expectation of being sold at some point, or IPO, or get a private equity fund to buy you, some kind of exit event, so that we can get our money back as investors. But there are situations or times when a company becomes more like a lifestyle company, and the entrepreneurs are doing okay, generating enough money to pay themselves a nice salary, but not necessarily much more than that to make this an attractive exit opportunity. So in situations like that, investors like ours have redemption rights, which means we can sell our shares back to the company at a predetermined return over a certain time frame, in order to make ourselves liquid and take our money back out. So that, again, is pretty standard, pretty standard deal terms that you'll see in a early stage fundraising situation. On a slightly more positive right is the right of first refusal, which is also in the same kind of bucket of investor rights. We typically understand that we're investing at this earliest round, and companies need to raise more money later. And if things are going well, we'd like to participate in those future rounds as well. So typically, first round or early stage investors have rights to invest again later on when the company comes to invest more money later on. And that's called a right of first refusal. That means we get to participate in future rounds along with every future investor, usually up to about 1x what we've invested in the first round. So those are the key kind of investor rights and the economic terms that we cover in the term sheets that we use. None of this is particularly new ground. So if you are trying to research for yourself how to come up with deal terms to offer to investors, there's plenty of material out there. We typically try to stick fairly closely to what's called the Series Seed documents, which are a set of template documents created by some angel investors on the West Coast to help make deal terms easy to understand and pretty standard, and therefore less expensive to create bespoke legal documents every time you're making an investment. So if you're looking to raise capital yourself, or if you're an investor who wants to get more informed about the kinds of investments you're making, or what's typical of investments in the kind of space you're interested in investing in, then the Series C documents, I think the website's called seriesseed.com. Those are a great place to start learning about some of the terminology and the deal terms that we're talking about. So with that, I'm going to start opening the Q&A session. So if you're still following along, would love to have your questions submitted through that, so I can answer what you're actually interested in hearing about rather than what I'm interested in talking about. So please throw those in, and I'll do my best to answer them now. This is the first question from Caroline. Lots of entrepreneurs are now told to raise money using convertible notes. What is Scan's view of them, and what deal terms are important? So you might have noticed that in my introductory discussion, I didn't mention convertible notes at all. We very rarely invest as an angel group in convertible notes. And if an entrepreneur comes to us with that offer, you can invest in our convertible note round, we would typically say no. And the reason for that is that those deal terms don't typically reflect the risk and reward potential of an early stage investment round. And I'll talk briefly about why that is. So convertible debt, for those of you who aren't familiar with it, it's debt. We lend money to the company, and the company pays us some kind of return for it. And that return usually comes as an accruing interest rate, so say 8% return per year, and then a right to convert that debt into equity at some point in the future. And that point in the future may not be known very well at the outset, which is one of the problems with the convertible note. But the idea is that it converts at some discount to the valuation that later investors invest at. Typical is 20% discount to the Series A round that's raised later. And it's a very well understood instrument. Lots of people invest using convertible notes, and people are happy to do that. We're not, as an angel group. And the reason we're not is that 20% discount to a valuation that we don't know what it's going to be when, in some unknown point in the future, isn't a very attractive way to be investing in companies. It could well be that that valuation is very high, and a 20% discount to that is not a great return on the risk that we're taking. It could also be that conversion event is 5 years in the future, and again, that's not a good return in terms of time frame for us to evaluate. There are situations where we have invested in convertible notes, but only about twice in our nearly 50 company portfolio. So it's pretty unusual. If there's a clear conversion event on the horizon that we can see, and we have good sense of the terms of that, then we might consider investing in a convertible note. But for the most part, we aren't interested in doing that. Moving on to the next question from Casey. Can you talk about warrants? Yeah, I can talk about warrants. Warrants are, again, for those that this is new information for. So warrants are basically options. But unlike options you might buy in a publicly traded company, they're only options issued by the company itself. So a company will issue warrants, and those warrants have, like an option, an ability at some predetermined point in the future to buy more shares at some given price. And you might say, in deals that we do, this is pretty unusual, but sometimes we have what is called warrant coverage. So we might be able to invest, say, 50% of the money we've put in already. We can use 50% again to buy more shares at some predetermined price in the future, and therefore generate better returns for us than in a standard situation where we don't have those options. Those are warrants. Options that allow you but don't compel you to buy at a future price. So if things don't go according to plan, they're pretty worthless. But if things do go well, then it's a way to potentially bridge the gap between different expectations of valuation in order to get a deal done. As I say, they're not hugely common in the deals we do. We're typically doing preferred equity investments that doesn't require some warrants to make the deals make sense. But in complicated situations, perhaps where the company's raised a couple of different rounds and needs some more money to finally hit its stride or make a better return for some of the investors who haven't made a great return so far, then you might see warrants appearing in deals. But for the most part, particularly if you're starting out as an entrepreneur, you're not going to spend much time worrying about that too much. Next question is from Michael Stevens. What investment trends do you see occurring in South Carolina right now? Any specific markets doing especially well at raising funds? So there's a few interesting things about thinking about raising capital in South Carolina or North Carolina relative to what you might read if you follow blogs from the West Coast or Silicon Valley angel investors or other places like that. And the trends that we see here are not anywhere as severe as the trends that you see in other places. So there's a lot of discussion about too much capital being put into early stage companies and valuations being in a bubble. And that's generally later stage than purely angel investing. But even at the kind of stage we're looking at, there is some discussion about valuations of angel rounds becoming too high or increasing. And if you happen to have seen the Halo report that was issued last week from the Angel Capital Association, there's some pretty eye-opening numbers in there about how valuations of early stage companies have increased over the last year or so. And some of that is true in South Carolina, although less so, because there are fewer groups making investments and therefore fewer people contributing to that kind of bubble. So the trends in South Carolina are more capital being deployed in early stage investing. We've had our groups expand from 80 people to 230 people now. Part of that is just because more people are interested in making early stage angel investing than they used to be. So that's a good trend for entrepreneurs and for investors as well. We're all getting better at doing this. In terms of specific industries, there hasn't really been very much of a change in that. The companies that we see typically in the Southeast are those that bubble up from the expertise of people in the Southeast. And that is often manufacturing or relating to manufacturing companies. A lot of healthcare expertise in the Southeast, so we invest in a number of healthcare companies in our group. But our investing activity spans a wide range of different industries, and so the investments that we see similarly cover a wide range of different industries. Other than that, there's really not very much that changes in early stage capital investing in the kind of situation we're talking about. There are some other kind of related changes that are interesting. Increasing familiarity and understanding of crowdfunding, not necessarily equity crowdfunding yet. That doesn't come in for at least a few more weeks yet. But donation type crowdfunding is an important additional route for entrepreneurs who want to raise money, and helpful for us in helping companies raise money more effectively. But I think that probably covers most of the investment trends. It's not that easy a question to answer, because it's a pretty stable and well-established asset class, and there are people understand how to do it and what is good behavior and what isn't. So it's hard to know clear trends. Answer the question next from Caroline. Can you describe redemption rights in more detail, and how do they relate to other ways investors can get an exit? So as I mentioned, redemption rights are a way for investors to get their money back in situations where it's not clear that everybody on the management team is incented for that to happen. And in those situations, obviously that's not an ideal right. We don't want to exercise that right and generate a 10% return relative to what we were hoping for when we first went into the company. But 10% is better than nothing, and it helps us get our money out. That's a useful right for us to have. Typically, there's situations though the company doesn't have the money to pay for those redemption rights. So it's kind of a nuclear option for us. If we exercise that, it probably means the company gets put out of business. So that's typically not a good scenario for us either. But it's kind of the nuclear option if other things that we have at our disposal haven't worked to encourage that entrepreneur to get to the exit that we were hoping for. And those other options that we had before that would happen are typically from the board situation. So our representative on the board is usually tasked with getting that company into a position where it's attractive to a potential acquirer, or some other exit scenario that we might be interested in. So we typically influence the company's trajectory through the board. If you work with an angel group like ours, we also have people on our team whose job it is to help you get to that exit. Our angel groups only really survive if there are exits and our investors get their money back. So we're well incented to help people do that. We have one member of the team, Matt Lackey, who is an expert in selling companies and can provide significant help to people along that way too. So there's a variety of options at our disposal to help companies exit before the redemption right is required, but it's there as a potential option if things haven't gone according to plan. Next question from Caroline. How do I learn enough about deal terms so that a negotiation with an experienced investor is fair? It's a good question. So we do this professionally, right? We understand where we can hide things in term sheets, or where particular ways that things are done could negatively hurt an entrepreneur in ways perhaps they wouldn't necessarily recognize from the outset. So you definitely want to be informed when you're participating in some kind of negotiation. And it's certainly in our interest too as investors for entrepreneurs to be informed, so that we don't spend time negotiating around things that just aren't important. We can all focus on things that are important. So the ways you can learn enough about it. The Angel Capital Association, which is the trade association of angel groups, has a wide variety of resources about how you can learn about this stuff. We do on our website too. If you look in the entrepreneur section, there's some guides to term sheets. There's seminars like this one where we try to lay out for people what's important and what isn't, and what the thinking of investors are as they go into making investments like this. There was a seminar yesterday from the Angel Capital Association that I think Thomas has linked to in the questions, which was interesting approach to help people understand what kind of deal terms are out there. The good news for you as a starting entrepreneur is this is well-trodden ground. So if you just spend some time researching it on the internet and look through the Series C documents and talk to other entrepreneurs, it won't take you all that long to at least understand the basics and figure out where things are important to talk about and where things aren't. So it's the odds are not necessarily stacked in the favor of just of the investor. And I think you also need to bear in mind that you need to pick investors that know what they're doing, and that have a reputation to protect in the market. If we as an angel group were known for being deceptive or try to trick people into unreasonably low valuations or whatever, we wouldn't be able to do what we do for very long. So try to pick investors that know what they're doing, that have some public reputation to defend, that you can do your reference checks on, and you can hear from other entrepreneurs about how things went in discussions with them. And that probably is just as helpful as knowing the technicalities of what registration rights are or what information rights are. The next question is from Thomas. The US Patent PTO has links to pro bono patent clinics for startups who cannot afford an attorney. Are there such clinics that do term sheets? That's a good question. I don't know of any. As I mentioned, the ACA materials, I think those are basically free to people. We do seminars like this and longer, more in-depth sessions over in person over lunch to help people understand term sheets. I don't know if there's really a free clinic type situation for that. The South Carolina SBDC, business development companies, the advisors to early stage companies, have some of that. I don't think it's necessarily free. I don't know if it's necessarily quite the same depth that you'd need if you were looking at equity raising. They're a bit more generalist than just that, but there are resources out there like that might approach some of that. As a quick plug, keep listening to sessions like this and ask questions, and that perhaps gets you to the same kind of knowledge level that kind of clinic would give you. Another question from Thomas. If you want to license your technology to a company, is there a way to find what the average royalty in the industry goes for yourself? I have no idea. Honestly, I don't know of any great resources for doing that. Other than talking to other people in the industries in which you're trying to do that, I'm not sure there's a general source for it. But I'll put that on my list, and I'll see if I can come up with a more informed answer on that for you offline, Thomas. Are there any demonstration videos for how to search for them, similar to how the Patent Trade Office? This goes back to the clinic question. Again, not as far as I know. I don't think there's any central resource. The ACA is a good source. The Angel Capital Association. There's a similar education entity called the ARI, the Angel Resource Institute, that does some more detailed and comprehensive education that they might have some resources that are helpful. The Series Seed website that I mentioned is useful too. There are a lot of people out there in and around the angel space. There's books by David Rose and other well-known angel investors that can give you some Brad Feld's book on venture capital term sheets is also equally helpful for angel investing too. So there is some literature out there that might be more granularly helpful than a presentation like this. If you're straight out of college, have a few patents filled, prototypes working, but no sales, is that stage too early for angel interest? Well, let's take each of those parts. So if you're straight out of college, no, it doesn't. We invest in first-time young entrepreneurs, and people are doing this for the fourth and fifth time in their 50s. So age of the entrepreneur isn't directly a constraint. Obviously, the more experience you have surrounded yourself with as a young entrepreneur, the better. And if it applies, if you need to have had 40 years experience to be successful in the business you're trying to raise money for, then that's an important one. But if energy and hustle is more important, or just as important for being successful at the stage you're in, then if your strengths fit the kind of business you're working for or working to build, then that's just as attractive to us as investors. Having patents filed is interesting. Patents take 3 or 4 years to go from being filed to being real, so we don't usually give too much credit for patents in the discussion that we do. If we think the technology is patentable, that might help with getting interest from investors, but for the most part, we don't give too much credit to that. Having a working prototype is crucial. So if you're just an idea still, then that is too early for the angel rounds that we're looking at. There are other investors that might be willing to invest at an earlier stage than we are. But we certainly want to see at least a prototype, and actually an actual product in a market is more interesting to us. No sales is right on the borderline. So if the company won't have sales for 2 years from where we are, then that's too early for us. If it might be a month or two away, and they can demonstrate traction in getting there, maybe a beta test has gone well, or they have customers lined up with LOIs or something, then if the company can persuade us that that is going to translate into real revenue soon, then that is late enough to be of interest to angels like us. Are any grants or competitions available where the winner receives free legal counseling and term sheet negotiations? Again, I don't know of any. There have been discussions around the Department of Commerce's innovation program about efforts to try to do that. I don't know if any of those were ultimately funded, but there are people that have tried to do things like that. I think there's no shortcuts. There's free information like this, and there's paying an attorney to be your representative in a deal term negotiation. And if you're serious about raising a large fund, you need to have an attorney provide advice. And that advice is typically not that expensive. Most of the attorneys that are involved in the early stage space recognize that this is a long-term relationship for them, and not just a simple fee for service at $250 an hour or something that the startup companies just can't afford to pay that. And so the attorneys that are associated with our group, we're fortunate to have a number of attorneys as members of our groups, and a number of attorneys like Nelson Mullins here in South Carolina, or Maguire Woods in our Asheville group, that are willing to spend some time with entrepreneurs to help them develop deal terms. Weish, the law firm in Greenville, is another firm that we use for a lot of deal work that we do. And they're willing to engage with you on a basis that makes sense for you and for them, so that ultimately you'll become a longer term client of theirs. So there are ways to get legal advice that's of high quality for relatively inexpensive cost when you're starting out. So I certainly would encourage you to speak to folks like that could be helpful to you. Question from Michael: any advice on how much equity a company should be willing to give up during the first investment round? Yes. So if it's an angel round like ours, we're typically looking for anywhere between 15 and 30% of the company. And that's true then of later rounds as well. A VC round is typically looking for 20 to 25% of a company. If the situation requires it, so you need to raise money more urgently than that, or you need more money than would necessarily be obvious from your valuation, then it could be as high as 50%. We're typically not going to be interested in investing 1 or 2% of a company, because that doesn't give us the influence over the company to be able to help them be successful that is crucial to a round like ours. Question from Rodley Michael: for an angel round of say 500,000, what is typically the investor looking for as equity? So as I said to Michael just then, so a $500,000 round, that would typically take 20% of the company if it's a $2.5 million valuation. In that 15 to 30% range is typical for investors of our kind. Now, some investors might have different expectations from that. If it's a single person investor who also wants to be an operational member of the management team, then perhaps it's a different set of thinking goes into it. But 15 to 30% is typical for a minority investor like ours. Is investment in ag tech active in South Carolina? Well, we don't see tons of ag tech companies come through our pipeline. We did invest in a company last year, Atlas Organics in Spartanburg, that has some ag tech activity to it. It's a composting and recycling company. But for the most part, ag tech companies are pretty unusual. There's an accelerator in Durham that we've actually invested in called AgTI, which helps ag tech companies get going. And there are certainly a lot of ag tech companies out there. It's a fairly hot space, and we certainly look at them when they come through our pipeline. But it's not a massive scene, at least within our angel group at the moment. Question from Casey: are there any common misconceptions entrepreneurs have related to deal terms? Yes. So they are the attractions of convertible debt. Those are attractive to entrepreneurs. They're very unattractive to investors. They are misconceptions around board structure and formal oversight of the company that sometimes comes as a surprise to investors. Sorry, as a surprise to entrepreneurs, especially if they're doing it for the first time. There's other misconceptions around what is an acceptable valuation. So a valuation of an early stage company in South Carolina is not the same, as I said, as a valuation of a Silicon Valley early stage company, because there are a few people trying to invest in companies like that. There's misconceptions around employment relationships too. That's an important part of discussions that we haven't really spent a lot of time on. But frequently, when you're taking outside capital for the first time, you have to give up all of your shares in the company and earn them back over time. And that comes as a big surprise to a lot of entrepreneurs who haven't seen that before. It's actually fairly standard practice. The idea is that we don't want to invest in a company where the entrepreneur has, say, 50% of the company at the end of it, and the entrepreneur can just disappear to the Cayman Islands or something, and we never see them again, and yet they still own half the company that they're not contributing to anymore. So a typical structure is would be we invest as investors. The entrepreneur gives up all or some proportion of their shares and earns them back over time. It's called vesting, and the typical schedule is you keep 25% and you vest the rest of your shares over the next 3 years in equal installments over 3 years. And that comes as a big surprise to entrepreneurs who don't necessarily know that is general expectations of investors. The other misconceptions then depend on how well informed the entrepreneur is. A lot of entrepreneurs don't necessarily understand that our focus as investors is to make a return on our investment, not just build a good business. So we want to build a good business, obviously, but we want to build a business that is attractive to somebody to buy, or to get to a position where it can in some other way return capital to us. And so that comes as a little bit of a learning curve for some entrepreneurs to figure out that our interests as investors are not exactly aligned with entrepreneurs who just want to build a lifestyle or a Main Street business, for example, or want to build a business for over 10 years that we want to see our money back earlier than that. So there are some questions here that have the links in from Thomas about the Angel Capital Association seminar from yesterday. Thank you, Thomas, for flagging that. That was a good session. Charlie, my colleague Charlie, was on that too, and enjoyed that. It was a good session. So if you can follow the link to that, that's certainly worth spending some time doing. Another question from Thomas: would you recommend an attorney help with term sheet negotiations, or only to write the term sheet into legally binding documents? So typically with the term sheet discussion, I wouldn't say an attorney was necessary to do that, because certainly if you're working with an established angel group like ours, the term sheet's pretty basic. It's pretty well established. We're just using the Series C documents. So an attorney might be useful to give you advice on understanding what some of it means, but the basic term sheet itself is not usually, you don't need somebody to draft that for you. And then the drafting of turning a term sheet into legally binding stock purchase agreements and investor rights agreements and things, definitely an attorney is useful, is crucial at that point. We'll typically have one on our side. So if you would like us to do the drafting of that, that's fine, and we've done it many times before, and so can do that pretty efficiently. If you've got an attorney that that knows about securities law and raising capital, and isn't just a general corporate attorney that's really done fundraising before, then that's an equally good source for creating the deal documents. The more bespoke and unusual they are, then the more expensive on both sides it is to figure out whether this deal is going to work. So we do also see companies using very expensive New York or Chicago lawyers to create documents that are perhaps a bit overkill for the level of complexity and sophistication we need to have in deals like this. So figuring out who the right person is to be your advisor on that isn't straightforward, but they are useful to have at that point where you're creating definitive documents, for sure. Is it possible to shadow a term sheet agreement? Term sheet agreement in progress? Probably not, because we're talking then about fairly confidential discussions between a company and their investors. So getting a live insight into that is pretty hard. But there's plenty of materials that I think will prepare you in other ways for doing that. Another question from Thomas: is a term sheet agreement usually completed in one sitting, or does it usually require multiple phone calls? Well, it usually takes a couple of weeks if things go according to plan. The actual negotiation and structuring of a deal usually takes a couple of phone calls. There's usually some complexity along the way that gets factored in over the course of a couple of weeks. A lot of time is spent around the structuring of deals, in tidying up what's been done in the company before. So very frequently that can take a long time if the company hasn't been incorporated in exactly the right way, or hasn't got board minutes approving the issue of this round of shares, or whatever the corporate housekeeping might be that needs to have been done, and very often isn't done quite as well as it should be. That can take some time. But the actual negotiation of a deal terms doesn't take all that long, because for the most part there isn't all that much to negotiate. It's all pretty standard laid out terms about what happens in this kind of round. So if we get to a position where we're having to negotiate over a long period, that becomes pretty unattractive for us as investors, because it either highlights this entrepreneur is going to be difficult to work with, or doesn't know what they're doing and hasn't taken the time to learn yet, or this is going to be more painful than an equally attractive investment in a different deal might be. So we typically like to keep this short, and the same is true for the entrepreneur too. If you're spending a lot of time negotiating with an investor deal terms that really don't need to be negotiated, then that should be raising some flags for you that this perhaps is not a partnership you want to embark on for the next 5 years. So it shouldn't take all that long, and it typically doesn't, other than the corporate housekeeping stuff that does take a while to do. And then I think this is the last question from Thomas. Do angels usually assist in negotiation with later rounds with venture capitalists, or they usually sit on the investor side again? Well, so at that point, as you say, we're on both sides. We're already investors, so we want to make sure the next round of investment is good for the company, but we're also potentially, with that right of first refusal I was talking about, interested in investing again at that round. So we're doing both at the same time. We are typically involved, despite that kind of conflict of interest, or being required to do both things at the same time, because we're often in a position to be able to match the level of expertise that the venture capitalists have that potentially the entrepreneur doesn't have, when talking about raising later rounds. So we can provide useful assistance. That's usually done again through the board representative rather than through the operational team of the angels, although we're involved frequently as well. That's usually done mainly through the board of directors that are ultimately responsible for deciding what the terms of that later round look like. But again, we like to be helpful, so we want that next round to come in a way that works for everybody, both those investors, the existing investors, and the entrepreneurs, to allow the company to be successful. Do investors expect term sheets already made for team members of the team? Example, a team of students working together. Yes, so the term sheets typically would impact the team in a number of different ways, and term sheets do cover those relationships. There's the vesting schedule that I talked about earlier when we were talking about misconceptions that people have. Typically, term sheets include an option pool as well that helps incentivize future hires or existing management team members, if they're more junior than just the founder level. That option pool is an important part of the term sheet discussion too. So it does encompass all aspects of the company, and if you're a number of students, a student team, for example, then the term sheet will cover you in the same way it would cover a team of experienced managers as well. So I think, thanks, Casey. Thank you, particularly to everybody that's donated. I certainly wasn't expecting people to do that. So thank you very much for your donations. I'm glad that this pro bono workshop proved to have some value and wasn't entirely pro bono. Those donations go to Venture Carolina, so will help us do other broadcasts like this, or other means of helping entrepreneurs get education, and investors too get education over time as well. So appreciate everybody's questions today. Thank you for the contributions. If you have other questions you'd like to talk about offline, we're happy to help you do that. Our next Crowder like this is going to be at the end of April. We're going to talk more in detail about valuations and figuring out what the valuation of early stage companies are. you get to hear from my colleague Matt to do that session, so not just me talking again. So hope to see you on that session then. Otherwise, feel free to contact us at any point through our website, scangelnetwork.com, and I look forward to seeing you next time.